Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, December 4th, 2017. This video is somewhat of a follow-up to the previous video I did today on the NASDAQ 100 and the semiconductors. In that video, I had mentioned, which I'd had recently, and most of you, if you've been following the markets closely, you're probably aware that we've seen some unusual sector rotation. It's not unusual to see sector rotation, but we haven't seen it out of the FAANG stocks in a while. By FAANG stocks, FAAMG, I'm referring to Facebook, Apple, Amazon, Microsoft, and Alphabet, which trades under the old Google tickers GOOG or GOOGL. Those are those five stocks. Make up a very large portion of the returns of the Nasdaq 100, and they're also the top weighted components of most of those in the S&P 500. So um, the point being, and I'm going to go through this video, is sector rotation is normally, especially in a bull market, a healthy thing when you have certain sectors or certain stocks that have advanced quite a bit and have become at some point overowned, whether they're overvalued or not, whether they're overowned. Those two things, or overloved, can be different. They can be mutually exclusive. You don't have to have these stock overvalued to correct. Just simply meaning overowned. If everybody's in it, who's left to buy it? Overloved, sentiment's too high. You don't have any shorts in it. So those are three of the conditions, and they can overlap. You can have all three combined, or you can have one or the three, or sometimes you don't have to have any of that for a stock to correct. But I'm talking now collectively these FANG stocks, namely the tech sector. So we're seeing that rotation out of the tech sector recently. Underperformance. It doesn't mean that they've gone down a lot. They are off their highs from a few weeks ago, but not far. So, underperformance can come in different forms. It could mean something is dropping while something else is going up, or it's dropping less. In this case, those stocks have been trading roughly flat to down for the last few weeks, while the S&P 500 and small caps, Russell 2000, made new highs. So that's where we're seeing rotation. And the sectors that are the beneficiaries as money's coming out of tech and semis. We're seeing financials do well, transportation stocks, energy stocks. So again, so far, that's healthy price action for the market, especially if that trend continues. However, if the weakness in the FANG stocks continues, and we continue to see money come out of those, I can all but assure you, if the tech sector drops 10% and the FANG stocks, most of those stocks, they tend to trade very tightly. If we see a 10-20% drop there, it's very extremely unlikely that the stock market, meaning the S&P 500, mid caps, small caps, that they will hold up or continue to rise. So, by sector rotation, it's been mostly a sideways to slightly lower trade in the FANG stocks. We'll see what happens here. But the point that I wanted to make is we've seen in recent years a very pronounced trend, a shift away from active money management, meaning I'm talking about professional money managers, mutual funds, hedge funds, pension plans. We've seen a shift away into index investing, where there used to be a lot of stock pickers. The problem was the majority of actively managed funds and managers, they were underperforming the stock market, and that trend had continued for a while. So then we saw that a lot of these funds come under pressure, money moving away from actively managed funds into index funds. So now a lot of the funds, and I'll go over that here, some of the well-known funds that used to be great stock picking funds, even this Fidelity Contra fund, I'll get to in a minute. You won't believe what the holdings are. Well, now I probably gave it away, but that's the shift that we've seen. Now, what does that mean? Well, what it means is, if and when there's a sudden rush for the exit out of the FANG stocks and a lot of money comes out, that will snowball on itself. As they underperform, you're going to see more withdrawals, and the market, meaning mutual funds as a whole, pension plans, they are chock full of those FANG stocks. I mean, they are by far the largest holding, and most of those have mirrored the indexes. And if they haven't mirrored the index, at least they've had those five stocks or four or five of those stocks as their top 10 holdings. So let's just go through this. And what I did here is I did a Google search on the top 25 largest mutual funds. This is from MarketWatch. and they list them here. Now, when you look at this, you're going to see there's a lot of overlap. Mutual funds come in usually in many different share classes. They have institutional shares, they have retail shares. Retail are what an investor like you would buy. Institutional, you'd own that in your 401k, for example. They have admiral share classes. So when we look here, you can see the largest mutual funds, the Vanguard 500 Index Fund. And then below that, this is the Vanguard Total Stock Market Fund, TSM. And you can see down here, here's the different share classes. So I'll just cross that out. I'll also cross out Fidelity Cash Reserves. That's a money market fund, not the type you get at the bank, but on a brokerage account or in your 401k. The money market funds there are technically mutual funds that maintain a $1 share price. This is a index fund as well from Vanguard. So down here you have that's International Vanguard Total International Stock Fund. So we cross that out. There's the Total Stock Market Fund again, which we already showed you up here. There's that Institutional Index Fund, which was right up here, just a different share class. The Fidelity Contra Fund, that is a stock fund. There's the same Vanguard Total International Stock Fund, and there's that same Total Stock Market Fund. This is a money market fund or a short-term bond fund, just a liquid fund from BlackRock. And then you'll stop here with the American Growth Funds. This is a fund, when my former life as an advisor, I used to have a lot of clients in this. I knew this fund well. And it is still one of the, I don't know what the recent returns are, but it's always done a great job. And in the past, it used to vastly outperform the stock market. This fund started out by doing what a mutual fund should do. A lot of research and good old-fashioned stock picking to find the best looking stocks and avoid the worst. And it did a good job for many years. Again, I've been out of that business for quite some time now, so I don't know what the returns on the American funds is. But or at least this particular fund, but they've always done a really good job as a family. But I just wanted to show you the holdings as we go through this. And again, I've already eliminated the duplicate funds or those that don't hold U.S. stocks, which are the international fund here and the money market funds that we have there. So let's just take a look at these. So that's the first three, and then Fidelity, Contra, and American Growth Funds. All right. So as one would expect, this is an index fund, the S&P 500. So the holdings are going to mirror that of the S&P 500. And there's your FAANG stocks right there. There's your Apple at about almost 4%, Microsoft at about 2.5%, Amazon, Facebook, and Alphabet right there, collectively making up about 2.6%. So as you can see, just like in the NASDAQ 100, although this is an S&P 500 fund, these market-leading FAANG stocks make up, good deal of returns, or at least the top holdings. Let's go back here to the next one. Vanguard Total Stock Market Index Fund. Again, it's just an index fund, so it's going to be the same story, different fund, different name, but you might as well own one, own the other. They're all going to. That's my point here. Is they're all chasing after the same stocks, and it's because it's been an evolution. They have no choice because the pressure. It used to be that these mutual funds wanted and they aimed to, and a lot of them years back did a great job of outperforming the market. Then in recent years, with that shift towards index investing, that happened because so many fund managers were underperforming the market. And you start to see investors pull their money out. And so the pressure was there to outperform, but you can't squeeze water from a rock. There just weren't that many talented fund managers to do so. So they've had to say, well, if you can't join them, beat them. If you can't beat them, join them. So they started indexing. That's all these are. These are the top holdings. Most of these in the S&P 500, NASDAQ 100. You can see the names there. You can see a lot of the FAANG stocks. This is a different index. This isn't the S&P 500. It's just another one. They're indexing funds where they use a passive management style, meaning they're not trading actively. They just go into whatever index that is and multi-cap core. So they, unlike the S&P 500, they can then buy small or go down to mid caps at least, maybe small caps. That's what they mean by multi-cap. Okay, so that covered, again, there was a lot of overlap. I eliminated the money market funds. So those were the two biggest ones right there by far. And you can see how many of that total stock market fund there is, how many different share classes. So lots of money in there. My point being that money is concentrated, or at least a very large extent, in these FAANG stocks. So if and when it's more of a matter of when money starts to move out. Now, will it move out as a group, as a sector with all those stocks? Because I can tell you there's been an extremely tight correlation because of that indexing between all the FAANG stocks. Now, a healthy thing would be to see gradual rotation. Maybe one company goes down for maybe Facebook, the air gets let out of that one. That has a nice 20, 30% correction while the rest hold up. And, and you see money gradually move out. But if we get a rush for the exits, and that's my concern here, as I'm sure others have this concern, this indexing over the years, we've never seen anything like this in the history of the markets. The trend towards indexing is that if there's a rush for the exits and everyone wants out, these funds start to rebalance to reduce their risk. They say, hey, we're overexposed to those FANG stocks. We need to take out. So they're selling. Values are going down. Now you see investors start to pull out of index funds saying, okay, I've had a great run in indexing. Now it's time to either put some money into cash or bonds or international stocks or whatever, or maybe even to a fund that's truly actively managed with a stock picker at the helm. That's the risk there, and that's what I'm trying to highlight here. So now we look at Fidelity Contra Fund. I mean, I've been familiar with this fund for 20 plus years. And the Contra Fund, let me just show you the investment policy. And this is almost funny. I get a laugh out of this when I read it. And this is the policy that it always had. It's a growth fund, so it's seeking capital appreciation. And its objective is to invest in securities with companies whose value it believes is not fully recognized by the public. Okay, let me say that one more time. Companies whose value it believes is not fully recognized by the public. And that's what the Contra Fund used to do. I became familiar with this one back in the 90s, and it used to do a great job. It used to outperform the market. Now, let's look at the holdings.